Hi everyone, welcome to another Learn, Grow, Invest meeting. My name is Jeremy McDonald. I'm the co-founder of Learn, Grow, Invest, and this community is where we focus on building the complete investor. Today we're going to be having a discussion on value investing with Brian Feraldi. If you haven't done so yet, please take a moment to share this video, like this video as well. So I'm just going to open with a brief word of prayer and then we jump right in. Lord, we thank you so much for this day and everything that you have given to us. Thank you that as investors, we can learn and grow by the experience and the expertise of others. Father, we pray that you will just bless this time in Jesus' name. Amen. All right. So I am going to just, introduce our guest here that I'm sure a lot of persons have been waiting on hearing from. So if you haven't heard before, Brian Feraldi has been intensely interested in money, personal finance, and investing ever since he graduated from college. He has consumed every piece of financial content that he could get his hands on. That sounds a lot like us here. He started investing in 2004, and he got, as with most of us, he got his teeth kicked in right away. He gradually got better, and his returns improved dramatically over time. And his individual stock picks have been beating the market's returns ever since then. In 2015, he became a writer for the Motley Fool. That's actually how I know of Brian. He has since written more than 3,000 articles on stocks, investing, personal finance, and he has appeared on hundreds of podcasts and videos. We're definitely happy to have him on our channel. In 2020, during the height of COVID-19, the Motley Fool launched the Fool Live, a members-only Zoom session where thousands of investors are taught investing lessons. Brian has spent more than 20 hours a week hosting Fool Live sessions, helping thousands of individual investors keep their head on straight during the worst of this crisis. And if you follow, I definitely encourage you to follow Brian on Twitter. He posts gems daily. So if you would just join me in welcoming our guest, Brian. Hey, Brian.
Jermaine, pleasure to be here.
Definitely good to have you. All right. So, Brian, I'm just going to jump right in. Tell us, a little bit about yourself. I know I would have said some things there, but, tell us about yourself. Tell us about your mission as well. I think everyone would be interested in hearing that.
Sure. I think you did a pretty good job with my rough background. I roughly graduated in college in 2004. I knew absolutely nothing about investing, about money. My parents were certainly great role models. They didn't overspend. They didn't go into debt. They always had good incomes coming in. But when it comes to just purely how do you build wealth? How do you become richer over time? That bit of education was largely missing. When I did graduate college, my dad handed me a book called Rich Dad, Poor Dad. This was, again, right at the end of the summer of 2004, which right when the housing boom in the United States was going bananas. But I read that book cover to cover in a matter of 2 days, 3 days. And then I think I reread it. It was the first time that I'd ever read something that said to me that you're in business for yourself. It's possible to build wealth. This is an income statement. This is a balance sheet. This is how the wealthy think about money versus how everybody else thinks about money. It just blew my mind that kind of thinking and that kind of education existed out there. And that just kickstarted an absolute love of everything related to money and personal finance and investing. So as you said, I read everything that I possibly could on money and investing. I mean, this was, again, in the middle of the 2000s. So podcasts didn't exist. YouTube didn't exist. Live streams didn't exist. All those things are tremendous resources that people have access to today. And then it was just a matter of trial and error and learning. And a big part of my investing journey is due to David and Tom Gardner, the founders of the Motley Fool, the company I just absolutely love. And 5 years ago, I had the opportunity to become a writer for them, and here we are.
And that sounds awesome. That's awesome. All right. So what were some of the things that you wish you knew before you started?
Geez, how much time do you have? I mean, pick an investing mistake. I made it. That is the unfortunate thing about investing is you read a lot of books, especially once you discover like Warren Buffett, for example, or like value investing, or different investors have different styles. And when you are young and know nothing, I was just naturally attracted to penny stocks. That was just the thing that was like, I just went right towards them. And my sole logic was, if a stock trades for $1, it can double a whole lot faster than a stock that trades for $50, right?
I've said that a couple of times. I've said that a couple of times. Yeah.
It makes such sense, right? There's nothing else. There's no other financial training or money training that we go through that would teach us otherwise. If you go to the grocery store and something's 99 cents and something else is $50, which one is cheaper? I mean, there's no comparison, right? It's the 99 cents thing is cheaper. The stock market just does not work like that. So I bought a whole bunch of garbage in the beginning with the sole thought of, I'll buy this garbage penny stock and I will sell it to somebody in a matter of days for some higher price. And that is it. And that's investing. I had wildly varying degrees of success. I couldn't tell you anything about the companies that I was buying. Who is the CEO? No clue. What's the balance sheet? No clue. Are they making revenue? No clue. The only thing I knew was a ticker and a rough story, and that the fact was the stock was trading for $1 or $2.
Yeah.
So I had lots of disasters doing there. And then from there, I had such bad experience with penny stocks that I kind of flipped and did the opposite, and I discovered what dividends were. When I discovered what like a dividend was, I was like, this is magical. You just buy a stock and own it, and then cash appears in your brokerage account. So I found stocks that were paying 20% dividends. How can you lose? How can you lose? I'm going to get a 20% in return just by buying and holding this stock. Spoiler, dividends are paid with cash, and only strong companies can pay dividends. So I lost money on that. And it was just really stumble after stumble after stumble. And slowly I learned lessons along the way. And that's one of the great things about when I started investing. I was so young. I was in my early 20s, and at the time, a few $100s was a lot of money. So losing $100 or $200 on a bad investment, it was painful. It's not a lot of money in the grand scheme of things, but it was very painful, and I still have those mental scars. But that's like wonderful training for later in life. Is to go through those painful mistakes early. I've unfortunately seen some investors that invested a 401k their entire life, know nothing about the market, know nothing about investing, and then when they turn 65, they say, "Hey, I'll give this investing thing a try," and they make all the same mistakes that I made when I was in my 20s, and they have no ability to replenish their wealth. So I'm super thankful that I got my teeth kicked in really early on, because those lessons are going to be with me for the rest of my life.
Yeah, I actually share with our community all the time. When I just got started investing, the first year I made an investment that lost 95% of its value.
That's impressive. That's actually hard to do.
Yeah. I mean, we'll talk about that offline, but it was a very important lesson in just understanding the importance of knowing what you're paying for. So yeah, definitely. So you're well known, Brian, for being a value investor. For those who are unaware, what does that mean? What does it mean to be a value investor?
Sure. So there's two broad categories that investors get broken up into: growth investors, value investors. And I actually wouldn't consider myself to be a quote unquote value investor. If you had to assign a label to me, I would consider myself a growth investor. But as Warren Buffett points out, those two things are really the same. If you are, all intelligent investing to a degree is value investing. You're paying less for something today than you will think it will be worth in the future, period. I mean, that's investing. Nobody is going to purposely pay more for something today that they think will be worth less in the future. The only way that you would do that is if you were betting against that stock or that equity. So all investing is value investing. It's saying this thing that I'm buying today will be worth more, significantly more potentially in the future. The tricky thing is when you talk about value investing, classically, value investing looks for businesses that are statistically cheap. Maybe they have a price to earnings ratio of 5. Maybe they're trading below their book value. Maybe they have more cash on their balance sheet than their market cap. Although that situation doesn't really happen all that much anymore with modern computers. But that's kind of like traditional value investing. And to a lot of traditional value investors, the idea of saying to them, hey, this stock is trading at 35 times earnings, it's cheap. Like that just doesn't compute to them, because you'd say, no, that stock is 50% more expensive than the average company in the market. It's not cheap. It's fully valued. But if you look at some of the stocks that I own and I purchase, many of them are trading for insane valuations. They're trading for 1,000 times earnings, or they're trading for 15, 20, 25 times sales. And believe it or not, I would argue that many of those are value investments, in that I believe that the future market cap or the future value of that company will be significantly higher in 5, 10, or 20 years than it is today. Therefore, even though I'm overpaying for those companies right now, I'm going to argue that they're actually a quote unquote value investment, just not viewed through the traditional lens.
Okay. Interesting. Because one of the questions I was going to ask you is, do you think value investing is still relevant? So based on your explanation just now, do you think the way that we've come to know value investing to be, is it still relevant now?
Yes, totally. There are plenty of investors out there that can look at the markets and say, this thing, again, is statistically cheap, and for the following reasons, it's going to rise in value over time. If you look at that style over the last 10 years, it's been a horrible place to put money. Things that were cheap have stayed cheap for 10 years. Even big, durable, dependable companies. But I don't think that value investing, quote unquote, traditional value investing is dead. I just think it's getting harder in a sense. The reason that it's getting harder is there's so much innovation that's happening in the world today. So much innovation, so much disruption. And one of the big trouble spots that you can get into with a traditional value investing is to say, this business is statistically cheap, and that doesn't make sense because this business will bounce back or whatever. However, if that company's business is rapidly heading towards zero, if the revenue and the profits are rapidly heading towards zero because of some disruption that's in the market, that's when value investing can really get you into trouble, because things that are cheap can not only stay cheap, but they can get cheaper as the earnings of that company, earnings power of that company decline rapidly. You could have made a very compelling case to a lot of investors that Kodak was dirt cheap in 2002. Like, statistically, it was dirt cheap. The problem was digital cameras were going to wipe out its business. So if you ever looked at Kodak and said, on a price to sales ratio, cheap, on a price to earnings ratio, cheap, on a price to free cash flow ratio, cheap, didn't matter. The business was disrupted. So that's where value investors can get into trouble. However, I still think that there is value investable principles that can be applied. You just have to be super, super careful that you're not buying something that's about to be disrupted.
Okay, that definitely makes sense, because the context of the investment or the valuation would be important. Definitely agree with you there. So based on that, what you just said, how would you say value investing is different from the other types of investing that you know of?
Say that one more time.
How would value investing differ? So if it is, I wanted to know the types of way that I could invest. If I don't want to value invest, what are the other types? How would it be different?
Yeah, again, getting back to that traditional, the two between the two, where there's growth investing and then there's value investing. Sticking strategically to those two, there's basically a spectrum of investors. On the one hand, you can go all the way to like venture capitalists. Venture capitalists, they are making a bet essentially on the founder. They're saying, here's a person with an idea, and if that person and that idea work out, I could make 100,000 times my money, or some ridiculous return, right? If you wrote the person that wrote the first check to Google in 1997 or whatever, what's the return on that? It's hundreds of thousands of huge multiples on their money. But what were you betting on? You're betting on two guys in a garage who had this cool technology for indexing the internet. And they were going up, by the way, against 11 other search engines that came before them. So talk about a high-risk bet. That one just happened to pay off spectacularly. Exactly. But if that is one style of investing, is venture capitalists can work really, really well if you get good at it. It's just knowing ahead of time, I'm going to place 100 bets. 90 of them are not going to work out. 9 of them are going to do okay. And one of them is going to do so spectacularly well that all the other 99 bets don't matter. And that's how a lot of venture capitalists succeed. So that's one style of investing. And when you're doing that, numbers can't really help you. I mean, sure, you can say, you can imagine if I can get this many users and they're doing this much revenue, but that's all fictitious. And many times those companies are creating a market for themselves. But that's kind of one spectrum to look at. On the complete opposite side of the spectrum is the traditional value investing, which is this business is priced for death. It's been around for a long time. It's not as bad as everybody thinks it is. And I'm going to realize value as the market kind of realizes that. So it's just a kind of a spectrum between the two. One of the best investors that I've ever met is David Gardner, who's the co-founder of the Motley Fool. And his style is basically buying high growth companies not too far after they come public and then just holding them for long periods of time. So he's almost like a venture capitalist mindset in the public markets. And that style, it results in lots and lots of strikeouts or lots and lots of bad picks. But the few that do well do so unbelievably well that the bad picks fade away into obscurity.
Yeah, you definitely don't need to be right all the time, as you said. So
you won't be. That's not how investing works. If you're expecting to be, you're going to be sorely disappointed.
Yeah, agreed. All right, so let's say that I've decided that I want to be a value investor. What would be the lens through which I look at companies? What are the things I'm looking to see? Maybe 2 or 3 things you would say. You definitely, if you're a value investor, these are the things that you'd be looking for.
That depends on what type of value investor you are. Again, are you just looking at things that are statistically cheap? In that case, you're going to have to get to know income statements really well, free cash flow statements really well, balance sheets really well. Many of them run discounted cash flow analysis to say, well, what are the assumptions? What are some realistic assumptions that I can put into my model? Therefore, what is the company worth today versus what is the price that it's trading at? Those are all tools that are well known to value investors. And again, when it comes to valuation is the way that I have looked at valuation has changed significantly over the last 20 years. A long time ago, I would have told you that valuation, when I first really got understood what investing was, I placed a huge emphasis on valuation. And I'm not going to buy this stock if it's trading at 20 times earnings. I'm only going to pay 19 times earnings or 18 times earnings or whatever it is. And it's really through studying the markets and watching how other investors have been successful and then studying my own investing history that I've really come to de-emphasize the importance of valuation. That's a really hard thing to wrap your head around, but I always look at valuation and what the market is pricing in, but I've learned the hard way that you really need to de-emphasize it depending on how the company is. I tweeted this earlier today, but in 2004, Amazon's PE ratio was over 600. Wow. If you looked at that, is there any way, if you do anything about valuation, that you would buy Amazon in 2004? No. 600? Are you kidding me? Like, if you know about PE ratio, you'd be like, it's going to take me 600 years to get my earnings back on this company. Forget it. The company is a 60 bagger. A 60 bagger. It was 60x return if you bought it in 2004 at a insane valuation of 600 times earnings. When it comes to that, when a company's future is wide open, right? A company like Amazon, it was clear even back in 2004, it's very risky, but the potential here is just massive. If this thesis works, the potential gains for this company are just huge, and you kind of have to hold your nose and just say, I'm taking a leap of faith here that the company is going to deliver on its potential, and that can be really, really hard to do, especially if you view investments through the lens of valuation first. So that's just something that I have trained myself to not do. Again, I always look at valuation, but it's like the 10th thing that I look at, not the first.
Okay. Interesting. So I'm curious. So what would be, so if evaluation is 10th, what would be, let's say, the first 2 or 3 things then? Because that's kind of where I think our community would benefit. Like, so let's say that you do know how to value companies and you're looking at those numbers and they don't really make sense, but then you kind of have a feeling about the company that it's worth more than what the numbers are showing. Like, what are some of the other things you'd want to connect in terms of the dots for that company?
Sure. So I have developed a checklist for myself that I post freely on Twitter, and your viewers are certainly more than welcome to look at it if it interests them. But I basically a few years ago I asked myself, what are the attributes in a business, in an investment, that I find compelling? Like, if a company had these attributes, they would be a positive. For me, those things are great balance sheet, lots of cash, no debt, a high gross margin, a high returns on capital, earnings, free cash flow, a widening moat, and moat is a euphemism for a competitive advantage. And there are many different sources of moats: network effects, switching costs, intangibles like brand or patent secrets, etc. I want a company with a wide open market opportunity. I want it to be the top dog and first mover in a market that is growing, that's expanding over time. I want clear signs that the company is innovative and has a history of rolling out new products and new services over time. I want customers to come in through word of mouth. I don't want the company to have to spend a ton on advertising to get customers. I want customers that buy the product in good times and bad. I want pricing power. I want recurring revenue. I want the founder to be running the show. I want high inside ownership. I want great Glassdoor ratings. I want the company to regularly smash its earnings targets. I want the company to buy back stock, and I want the stock to have smashed the S&P 500. Wow, is that asking a lot? Like, that is asking a lot. And the number of businesses that check all of those boxes are very, very, very few. So that's all the things that I look for on the plus side. On the minus side, I also check for things that could bust the thesis. I hate investing in companies that only have 1 or 2 big customers. Like, if you come to me and say that Walmart is 60% of your sales, not interested. Like, that means one decision, one bad relationship busts the whole company. No, thank you. I want thousands of customers. I don't want stock-based compensation to be through the roof, because that dilutes me as an outside shareholder. I don't want a binary event to make or break the thesis. The most common one of those is FDA approval. If FDA approval comes through, the stock goes up. If FDA approval does not, the stock goes down. That's a binary event. I don't really want to bet on binary events, although I do own some stocks that are required FDA approval, for example. So it's just a matter of looking at all the attributes that I find compelling and subtracting all the attributes that I find not compelling, combining them together, and then ranking stocks according to that list. And then I find the companies that meet the most attributes, and I buy those.
Yeah. That sounds like a very rigorous list. But when you're finished with that list, I mean, if you put your money on that list, then I figure you'll have some sizable positions in those companies, right?
Yes, and the higher a company scores on the list, the higher the quality the business, and the more confidence that I have in it. That doesn't mean that I won't invest in companies that do poorly on my list, but I still take them through this process so that I know at the beginning that I'm assuming more risk than I would be if I was investing in something else. And boy, have I better be compensated for that risk. And the way that I'm typically compensated for that risk is with enormous potential. So I typically won't stray from my list unless I believe that the stock has an outside chance of doing a 10x return or better.
Okay, great. So a few weeks ago, we had a conversation on this channel about diversification versus concentration. Right? What's your take on those two approaches? Do you have a diversified portfolio, or are you concentrated into a few key companies?
Both. I know that's confusing, so let me explain. I have, again, experience has taught me that I can deceive myself.
Yeah.
I have in the past been convinced, 100% convinced, this stock's going up. I am convinced this stock is going up. And guess what happens? Not that thing. That stock has gone down. So I have a history of getting so excited or so into investments that I have put a lot of my capital into them, and then those positions have gone the wrong way. Because of that, that has informed my current strategy. I am a big fan of buying lots and lots of positions. I buy in very small increments, about half of 1% of my portfolio at any given time. And I space out those purchases over a period of months or even years. So my investment portfolio is very much like a cruise ship. Like I have to think way ahead. Like, okay, I want it to go in this direction, so I better start steering the ship now. But it's very slow moving. Because of that style, I am happy. I own something like 70 or 80 stocks. I actually don't know the exact number right now. Now, if you look at that and you talk to people that are very big fans of concentration, they'll be saying, well, that's stupid. Well, you're basically an index fund. Why are you even bothering to pick your own stocks? Yeah. My counter argument to that is, while I do own 80 stocks, my top 10 positions are about half of my portfolio. Okay. The difference is those top 10 positions earned their spot. They started as very small positions for me, and the market returns have been so enormous that they have grown into my biggest positions. I didn't will them there by buying and buying and buying and buying. I bought a little bit, and then it became a lot. And I've learned that you do not want to sell your best performers. You want to do the opposite. You want to sell your worst performers so that you can reinvest into your best performers.
Okay, that is very, very interesting. So do you rebalance your portfolio at all?
Depends on what you mean by that. I don't have any strict guidelines for doing so, other than to say if I no longer believe that a company is the best place for my capital to be, I have no problem scaling out of that company slowly and putting it into higher growth investments. That's not to say I don't like the company, but I just think my money is better served elsewhere. For example, roughly 2.5 years ago, I sold all of my Apple stock. Not because Apple isn't an awesome business. It's a tremendous business. But I just said, given this company's size and likely forward growth rates, there are other investments that I would rather own instead. So I will scale out of businesses once a company reaches such a gargantuan size that I think market-beating returns from there are less likely.
Okay. So, well, what I meant by rebalancing is that's a topic we also covered a few weeks back, is where you determine target allocation per stock for that portfolio, and then if it deviates too far from that target allocation, you either sell from that stock and put in your other positions, or you add to your other positions to maintain a certain weighting of your portfolio. So that's what I was talking about.
Yeah, so I don't have any hard or fast rules such as that, other than to say if a stock became more than 10% of my portfolio, I might consider attributing it. But again, it would still depend on, do I still think this company has a tremendous growth runway ahead of it or not? The only tricky thing about having rules like that for yourself, unless they're macro based, such as like stocks versus bonds, you really risk selling your winners and buying more of your losers. And that is the exact opposite thing of what I suggest people to do. So I wouldn't force rebalancing on myself in that manner because I don't want to do exactly what I just said, which is sell winners and buy losers.
Okay. That makes a lot of sense, actually. Interesting. All right. So what would be your recommendation for brand new investors? A few of our community members would find our channel for the first time. They're brand new. They're not sure where to start. What would you recommend for them?
Educate yourself. Number one. The best investments that you can make in the beginning are in your own education. Listen to podcasts. Read books. Get on Twitter. There are so many wonderfully helpful, smart people on Twitter that openly share information. But really, I had a tweet earlier today about 24 investing podcasts that everyone should that I listen to. Just listening to that just listening to those podcasts on a regular basis will dramatically enhance your personal knowledge about investing. So the best investments you can make in yourself when you're first starting out are in your own education. As for the money, as for what you should do, that totally depends on you. While I am a huge passionate fan of investing, I don't think anybody should be investing if they have credit card debt. I don't think anybody should be investing if they have a car loan. I don't think you should be investing in individual stocks unless if you have a retirement plans are funded. So make sure you get that done first before you start going into the stock picking world. But it really depends on your own interest level more than anything else. Does talking about investments interest you? Like, do you think about investments when you're like on a walk and that kind of thing? If so, you're an investor, and it can behoove you to make some investments, buy some stocks that interest you. Nothing speeds up learning like skin in the game, like actually having money on the line. However, if you have no interest in investing, as 97% of the population does not, just buy index funds and call it a day.
Yeah. Okay, cool. All right. All right. So thank you so much for that, everything that you've shared so far, Brian. I'm processing as you're saying, because a lot of the things you've said so far, some of the persons from the community in the chat are kind of, I think they're understanding how my brain is working to some of the things that you're saying right now. So what we'll do, I'll pause for a brief second, ask persons who are watching, definitely thank you for joining us. If you have not done so yet, I'll ask you to like this video. I will be sharing the link to Brian's profile and how you can contact him in the description after this video is complete. So you don't have to worry about being able to reach him. And if you have not done so yet, please subscribe to this channel, all right? All right, so Brian, I'm gonna ask you, well, really that covers most of my questions that I had for you. We did get some questions from the audience though, so I'm gonna just go through those now, and that should give us enough time as well. So Chike from our community is asking what guides your investment decisions?
My checklist.
Okay.
I mean, that's the easiest way to answer that question. I use a checklist, I use watch lists, and I use an investing journal. So before I buy any investment, I will go to my checklist, and I've had this for a number of years. So I have several hundred companies that I've run through that thing. And at any given time, if I was to buy a stock today, for example, I would go right to my checklist, and I would say, what company or what stock or stocks offer the best combination of the following three things. One, business quality, so the highest quality business as possible. Two, potential, which companies have the highest potential to deliver the biggest returns. And three, valuation, which company what company has the highest combination of quality, potential, and valuation at any given time. And that's what I buy.
Okay, cool. I think that actually should answer. I think Sizzler Kalonji from the audience was asking, about, how you feel about the qualitative aspect. And I think you just kind of answered it there, right? Because those are some of the qualitative things that I guess you'd be looking for in when you're investing. All right, so Sizzler, let me know if that answers your question. If not, you can feel free to ask another. Another question from Chike is asking, do you invest only in the US or do you invest internationally?
So I am not opposed to investing in international stocks. I just want to invest in first and foremost awesome companies. So I'm not, but I'm not the type of investor that's going to force myself to invest in international stocks. And I'm spoiled in the U.S. in that there's a whole bunch of awesome international companies that want to that list their stocks in the U.S. The other thing I will say is, what is an international stock? Is Apple an international stock? It's listed in the US, but 70% of its revenue is derived outside the US? Amazon gets a big chunk of its revenue and profits from North America, but what's its growth opportunity? Not North America. It's investing heavily in India, for example. So I don't necessarily force my companies to my portfolio to say, oh, I want 10% from Europe and 5% from Latin America, and I don't do any of that. The other thing I say is, what are the best companies that I can find today, and I buy those. And for many of the companies that I buy, the big opportunity for them is international. It is outside the U.S., but I like the idea of buying U.S. listed companies with U.S. accounting standards who have growth opportunities outside the U.S.
Okay, makes sense. So apart from stocks, do you diversify in any other asset classes? If yes, what determines those picks?
Sure. I own my home. So that's my real estate exposure. I keep some cash and I have stocks. Those are the asset classes that I choose to invest in. I don't own bonds. It's not that I'm against bonds, but bonds have not made sense to own for 15 years, really, because solely based on interest rates. So I will say that I have no problem with people investing in real estate, for example. If real estate is your thing and you have the interest in buying and owning rental properties, that can be a fantastic place to invest. I have no problem with people investing in small businesses. Another great place to invest. I have no problem with people investing in crypto. I personally do not own any crypto, although I have been warming up to it much more in the last year than I have at any other time. But I do not personally own any crypto. The thing that I know and the thing that I study is business, and business means investing in stocks. And I am very comfortable having the lion's share of my net worth in the stock market, and probably will be always, simply because that's the best performing asset class over 20, 30, 40 years. History has shown, and I think it will continue to be that over the next 20, 30, basically for the rest of my life. So I don't bemoan anybody that invests in any other asset class, but the thing that I know is the stock market. So that's where I want my money.
Okay, fair enough. So you don't think even with the most recent moves for crypto that the rates of return may start to be a little bit more comparable, or maybe that's why you're warming up to it now?
It more has to do with my own ignorance about it. I've studied it, I would guess, more than many people that own it, and I just have never been comfortable with it. The fact that it doesn't produce any cash flow. There's no cash flow that comes from it. But the thing that I can't get out of my mind is, should there be a currency of the internet? I think the answer is yes.
Yeah.
That's the best bull case that I can give on crypto. Is, should there be the currency of the internet? Yes. Is Bitcoin it? Is Ethereum it? Is that I don't know. Possibly, but I think that they have probably reached the tipping point on adoption. And when you see companies like PayPal, for example, or Square saying we're going to be accepting Bitcoin, those to me are big votes of confidence. But having said that, I do not own any Bitcoin, and that doesn't mean I will never own Bitcoin. I just do not own any right now.
Yeah. All right. Yeah, I agree. So a question from David Rose is asking, how do you value a company for a long-term view? I think you might have gotten into most of that already. So let me maybe switch to another question. So David again is asking, what's your view on the US market now with all the stimulus money that has been entering the system?
That's a macro question, and macro questions are unbelievably hard. I will say that I view all forecasts with skepticism. I view macro forecasts with extreme skepticism. You could have gone back to 2009 and said, we are printing so much money to save the banks, to save all these industries. Inflation is going to be crazy over the next 10 years. And that is a logical conclusion. So logical, right? More money, Fed balance sheet going up, therefore inflation going up. What actually happened to inflation? None. It was so muted. It was basically 1%. Or 2%, under 2% over the last 10 years. And moreover, the inflation was actually extremely bifurcated, right? It costs less to buy a TV or a computer or an airline ticket today than it did 10 years ago. But the cost of college tuition and healthcare and daycare, those things have skyrocketed. So it really depends on what you mean by inflation in that case. To answer the question about the macro and valuations, is there influence on stock market valuations due to the drop in interest rates, due to what's happening at the macro level? I have no doubt. How do you sort out what that means for now and in the next 5 years? I have no clue. And I don't think anybody could sort that out. That's why my sole focus is buying awesome companies that I think will be worth lots more in the next 5, 10, 20 years, and just being completely okay with whatever happened to stock prices in the meantime. Do they go up? Great. Do they go down? Great. Do they go sideways? Great. I don't care. I care about where they're going to be in 5 years, not 5 days or 5 months.
Yeah. Got you. All right, cool. So Romain is asking, what do you think about Robinhood as an investing app for the long term? I'm not sure if you have any thoughts on that.
Yeah, I don't really like Robinhood. I don't really like that they purposely push you to open a margin account. I don't like that they give you options tradings, all that kind of stuff up front. I don't like that they kind of gamify investing. On the flip side, I do like that it's very easy to use, that they make it so that you can buy and sell investments with $0. I do like that they have attracted millions of new investors to consider looking at the market. So there are positives to Robinhood, there are negatives to Robinhood, but what broker you use shouldn't matter. The only thing that should matter is, do you own stocks and what investments do you make?
Yeah, agreed. All right, Ramin again is asking, how do you adapt to the up and down movements of the market?
How do I adapt?
Yeah.
By doing nothing different and just accepting that they happen. It's like saying you're on a boat, you're going across the Atlantic Ocean. How do you adapt to the waves going up and down? You go up and down. That's what you do. You just know that occasionally there's going to be some enormous waves. They're going to be gut-wrenching to go through, but you're focused on where you're heading, not what's happening in the right here, right now. The most important thing to know there, and this is something that trips a lot of people up, including myself in the beginning, you have to understand that there is a 100% correlation between a company and its financial statements in the long run. The stock, the company, the financial statements are all 100% correlated in the long run. Those things are 0% correlated in the short run. 0%. I joked about this earlier today, but in Zoom, Zoom's most recent quarterly results, revenue was up 369%. Earnings were up 800%. The stock is down 40% in the last 7 months. Square those things for me. You can't. The business is doing awesome. Like, it couldn't be doing better. The stock has done terribly over the last 6 months. Was it too highly priced 6 months ago? Entirely possible. Was the market expecting even higher results over the last quarter? Entirely possible. Was forward guidance bad? Entirely possible. There could be a bazillion reasons why the stock is down over the last 6 months. But what I will tell you is, if Zoom can continue to grow revenue and profits at a very, very, very high rate over the next 10 years, it will be worth more than it is today 10 years from now. If it can't, it won't, period. But what happens to Zoom stock in between? Anybody's guess. So I just intuitively know, if I'm right about the business, that I will eventually be right about the stock, but I will have no clue what is going to happen to stock in the short term. That's why I never get overly excited when I see a stock go up, just like I never get overly down when I see a stock go down. I just know that's just short-term factors that affect stock prices.
Yeah. So one of the things that I hear from a few of our community members, so they'll hear about a stock, it's buzzing or it's trending somewhere, and then they buy it, and then it feels like as they buy it, it goes down. And they have no idea how to explain that. They don't know how to feel about it. They feel like maybe they made a wrong decision. And what you're saying is, if it is that you bought a solid company, if it goes down in the short term, it shouldn't matter. If you bought it for 5 years or 10 years, if you say you're value investing, then it should not matter that it went down shortly after you bought it, right?
If you buy a company and you like that company, and that stock goes down, and you don't want to buy that company more, you didn't like that company in the first place. If you should know the businesses and the opportunity and the potential so well that when a stock declines, that excites you. If it fills you with fear, you didn't do enough research. You didn't develop the conviction in the company over the long term. So that's what you really need to focus on. A really simple way to explain this is this. Pretend you're an early investor in Starbucks. Starbucks has 10 stores, and it's doing, let's just say, $10 million in revenue and $1 million in profit. You buy the stock, okay? The next day, you buy the stock. Let's just make up a stock price. Let's say the stock price is $50. Okay, you're like, I think Starbucks is going to catch on. I think there's room for more Starbucks to grow. I think the revenue of this company, the profits of this company, will grow. The next day, you see a news headline that commodity coffee prices are up 30%. Okay, something happens and commodity prices go up 30%. What's going to happen to Starbucks stock? It's going down. It's probably going down hard because investors are thinking, coffee prices up, Starbucks profits are going down. I want to sell today. That would explain, it would be completely rational that Starbucks stock would decline hard even the next day. But if you bought Starbucks because you think, well, there are 10 stores today, and I think they're going to be 10,000 in 20 years, what happens to the stock the next day doesn't concern you or shouldn't concern you. What should concern you is, are they opening stores? Are consumers coming? Is the brand catching on? Is the company making profits? Is it deploying its profits properly? Is the long-term potential of this business still intact? The answer is yes. You just have to accept that in the short term, stocks you buy are going to go down and stocks you buy are going to go up, and there's nothing you can do about it.
Yeah, agreed. All right, so Greg from the chat is asking, how do you follow closely 7 companies, right? Is it the same model that you mentioned? Is it an automated thing, or how do you manage that portfolio of 70 stocks?
The answer is the Motley Fool. I'm a part of a community that the community never invest alone if you don't have to, right? So the companies that I own, first off, I want to own all of them for the long term. They wouldn't be in my portfolio if I wasn't confident in them for the long term. But this doesn't mean that I read every press release or anything like that on the company. if I buy a stock, again, I buy it with a multi-year time horizon. So I will check in on the companies sometimes that's weeks, sometimes that's quarters, and I will check, okay, and basically ask, is the thesis here still on track? If I bought a company because I expect it to grow rapidly and it doesn't grow rapidly, that means that I was wrong. Therefore, that could be a potential stock that I could look to sell. If I bought a company and it's growing even faster than I initially thought it could, maybe that's a good stock to add to. And it just depends on the company too. Take a company like MasterCard. MasterCard's one of my top holdings. I can't think of another company where I could look at the press release from MasterCard in 2 seconds and decide, is it good or bad? Right? MasterCard is like, revenue is up, profits were up. See you in 90 days. That's how MasterCard goes. Company like Tesla, I read through every single word of the transcript. It's such a different stage of the business where every detail. First off, it's just fun to follow Tesla, and two, every detail. It's in such a hyperscaling stage that it's a much riskier investment. So it just totally depends on the company. But to truthfully answer the question, the answer is I depend on the Motley Fool largely to help me track my investments.
Yeah. Okay. Cool. All right. So Francine is asking, how do you feel about ETFs?
They're great. ETFs are great ways to get exposure to certain trends, certain parts of the market, doing so in a very low cost way. Many people use them as trading vehicles. I'm anti-trading. I am pro-investing. I am pro-owning. So if you are buying them to own them for long periods of time, ETFs are great. If you're not, then you're misusing them.
Okay, cool. All right. Sizzla is asking, what recommendation would you have for someone who wants to enter the US or Canadian market where there are thousands of companies to pick from, coming from a market like Jamaica where we have less than 100 companies? So how would you, where do you start?
Start with companies that interest you. Check. There's a bazillion places to get stock ideas. I mean, you've heard of all of the biggest ones. Just go to there's a wonderful website out there called FinViz, FINVIZ.com. That's the best free screening tool that I've come across, and you can go there, and that has thousands of stocks, and you can sort by any metric that you'd like: market cap, by sector, by industry. You could sort by size, you could sort by growth rate, and just start to pick through them. I would be remiss if I didn't answer the question honestly and say I was a paying member of the Motley Fool for many years before I started to work for them. And I think the stock picking skills of David and Tom Gardner and just their stock advisor service, which is completely reasonably priced, that is a wonderful place to come up with ideas and start picking from a pre-screened list.
Okay, cool. All right, Stephen is asking, what are some of the index funds you'd recommend to a newcomer? I guess you kind of answered that one, I would say, in your last feedback. So Stephen, if you still have a question, let me know. But I think it's safe to say you answered this one already, Brian. Let me go to our next one. All right, after having done, Kemil is asking, after having gone through your checklist and you spotted some companies with tremendous growth, how do you set a goal now for that company, and when do you sell or take profits, if any at all?
There's 11 reasons that I sell. I'd be happy to tick through them really quickly. Number one, sorry, it's hard to get my finger on the screen. Number one, I was wrong. If I was wrong, if I bought a company for ABC reason and ABC reason is incorrect, I'll sell. That means I was wrong. Number two, accounting irregularities. If there's fraud in the numbers, I sell. Number three, if the company makes a big acquisition that I don't like, I will sell. If the company executes its mission and doesn't have a new place to go, I will sell. For example, if Apple was just the iPhone company, it's more than that, but if it was just the iPhone company, it's pretty clear that they succeeded, but how are they going to grow if they were just the iPhone company? They really can't. They already captured their market opportunity. If there's no second act for them to drive their long-term growth, I'll sell. Number 5. Cultural deterioration. So CEO leaves, mass employee exodus, some clear signs that something is going wrong at the culture of the company, I'll sell. Number 6, extreme valuation compared to the opportunity. That's a really tricky one. Take a company like Airbnb. I like Airbnb, but this is just an example. Airbnb is like $100 billion company. How good of an idea is Airbnb? Could this be is this $1 trillion idea? Maybe. Let's say that you think that the best case scenario for Airbnb is that it's a $150 billion idea. It's a $150 billion company. All right. Well, the company's already worth $100 billion. So if the best case scenario is a 50% gain, no thanks. That's too much risk, especially given the valuation. I would have, if I was going to buy Airbnb at a high valuation, I would have to believe it's at least a $500 billion, could be a $500 billion company one day. So the bigger the market cap is compared to the ultimate market cap, I will sell if I think there's no gains to be had there, or limited gains given the risk. Number 7, if the company is too big of a position for me, I'll sell it. Number 8, if I no longer want to follow a company, I just lost interest in it, I'll sell it. Number 9, if it gets acquired. Number 10, this is the probably most important one. If I need the money for my personal life, AKA the reason that we invest in the first place.
Exactly.
So if I have a big expense, coming up, I will sell to pay for it. And the final reason is tax loss harvesting. I will sell losing stock to lower my tax bill if need be. But ideally, the reason I buy stocks is to have them compound my wealth. And if the company's awesome and the business is awesome, I don't want to sell it. I want it to keep compounding my wealth for as long a period of time as possible.
Okay, cool. Thank you for that. Stephen is saying that you should consider going into motivational speaking.
Thank you. I get really excited about investing.
Yeah, us too. So you're definitely in the right place. Well, I think that's all the questions. If I missed any of your questions, please definitely post them in the comments after the video. I'll just tweet them out and tag Brian, and he'll answer them when he has a chance. Brian, I want to thank you so much for joining us. When I first reached out to do the session, so I definitely thank you for agreeing to be here. I'm sure those who are watching it after the live will definitely appreciate some of the answers that you've given us. It will give us quite a bit to think about. So for everyone who is, well, do you have any final words, Brian, before?
No, thank you. This is a lot of fun. I always enjoy chatting with people. And you got a killer setup with that chair and that pseudo green screen in the background.
Thank you. Okay, great. So we'll definitely keep you posted, Brian, if any questions come in afterwards. So yeah, cool. Thank you so much.
All right. Thank you for having me.
All right. Take care, Brian.
Bye.
All right, guys. So definitely thank you so much. If you're still here, please like the video, subscribe to this channel if you have not done so yet. If you have found value in this content, please share it with someone, share it with a fellow investor. It's definitely been, this meeting was a fun one. Hope it was the same for you as well. Great. Happy to see that you've learned something. That's why we're here. So I just want to leave you with a scripture before we go. So we want to remember, again, giving acknowledgement to our Lord and Savior, for it is He who gives us the ability to produce wealth. That is in Deuteronomy 8, verse 18. And I'm really going to encourage you to connect with us on social media. We're also on LinkedIn, we're on Twitter, we're on Facebook, we are on YouTube, where you're watching this now. If there's anything that we missed, yes, only like it once, definitely. Yes, so thank you so much for checking us out today, and I will see you in the next one.